Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're looking at the world's most valuable company, Apple, after they reported their quarterly earnings results last week to see if investors should consider buying the iPhone maker. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into Apple specifically and do a broader breakdown of the earnings report and take a look ahead and look at other fundamentals to help give a better picture of Apple, let's just look at the broader tech earnings picture and the earnings picture in general. So last week saw nearly pretty much all of the heavyweights from Apple and Microsoft to Amazon and Facebook and Alphabet all post blowout first quarter results in the last week of April. Wall Street's response to the show of strength was largely muted, which highlights a combination of really high expectations, already impressive runs over the last year plus off those coronavirus lows, and also the possibility of tech deceleration ahead. So based on some of our latest Zacks data, we're going to take a look at what we call the elite group of 5 big tech players, which is Apple, Microsoft, Amazon, Alphabet, and Facebook. So it's not those FANG companies, because that includes Netflix. Netflix is not in this. So replace Netflix with Microsoft, and you have these big 5 companies that have the largest market cap for these tech players. So as a whole, these companies in the first quarter earned $74 billion in the March quarter on $312 billion in revenue. So this group of Q1 earnings, their revenue and earnings were up 104% and 30% respectively year over year. So looking at these 5 top tech players, as we mentioned, their earnings so far, or their earnings in Q1 were up 104% on 41.5% higher revenue. And if we look ahead, this is where we're seeing a bit of a slowdown. So if we look ahead then to Q1 of 2022, so next year, our estimates are calling for, which would be very hard, a pullback. So we're calling for 13% decline on the bottom line in a 4.5% higher revenue. So this hard to compare period is setting these stocks up for the possibility of just slower and slower growth going forward. So this is where we're possibly seeing some of the less than ecstatic reaction to some of these stocks doing so well, is that it's then going to be hard to follow up this growth. So obviously, if we look then at the bigger tech sector for quarterly results, we're calling for overall, we're calling for 50% tech growth in the quarter on 23% higher revenue, and then that slips down to 24% on 15% higher revenue in the Q2, and then it gets slower and slower going forward. So that's that tech deceleration possibility we're talking about. Obviously, these estimates could continue to go up, and then overall, if we look at the full S&P 500 earnings for the first quarter, we're calling for about 43% earnings growth on 7% higher revenue. And then we're actually calling, unlike tech, we're calling for even bigger earnings in the second quarter. So about 57% overall for the S&P 500 on the bottom line, and then 14% on the top line. So whereas tech is going in the opposite direction, we're calling for even bigger growth in the second quarter for the overall S&P 500. And then some more stability, whereas tech's going to decelerate against these massive, massive results they've had over the last year. And then on an annual basis for the S&P 500, we're calling for about 28% earnings growth on 9% higher sales in 2021, with then 13% higher revenue, or 13% higher earnings in 2022 on 6.3% higher sales. So tech has an outsized impact on all of this, and with tech going down, 2023 will be a little bit less than that. But this is also coming against very aggressive growth over the last year. So technology still seems like one of the better long-term bets on the market, and the stocks could continue to climb given the bullish backdrop. We just have to note that against these hard to compare periods, there clearly looks like there could be some near-term deceleration in the next year. As we mentioned, they're coming up against these periods of really outsized growth, especially for these big, huge tech companies. But as we mentioned, the backdrop overall is really bullish. We saw some impressive figures come out last week. So US GDP jumped by a seasonally adjusted annual rate of 6.4% in the first quarter to put the economy within 1% of its pre-pandemic levels. And this was according to new Commerce Department data from last week. We also saw that the consumer-focused U.S. economy was boosted by a big uptick in spending, which was driven in part by a record 21% jump in household income in March. Obviously, this was propelled a lot by the latest round of stimulus checks, and it fueled a 4.2% month-over-month jump in spending, which was the biggest month-over-month jump since last summer. So we're seeing some pent-up demand and the stimulus checks working to help drive some of that consumer-driven U.S. economy. So overall, the largely successful vaccine rollout in the U.S., coupled with the natural economic rebound and the injection of trillions of dollars in the economy, has pushed up U.S. GDP projections to over 6%, which would be the strongest in roughly 35 years. We just talked about how the earnings strength is there as well, especially for the broader S&P 500. So with this all in mind, we're now going to look at Apple, which continues to be the biggest company in the world. And they reported their Q2 FY21 results last week on Wednesday. So those results came out April 28th. The company topped our Q2 estimates with revenue up a whopping 54% to a record for the period of about $90 billion. And this blew away our top line projections and top line projections across Wall Street. Meanwhile, its adjusted earnings climbed about 70%, so 67% to $1.40 per share, which beat our estimate by 40%. So as we mentioned, with all these companies, these big tech companies, blowout earnings in the first quarter, or what's considered the first quarter, even though this is Apple's Q2 of FY21. But still, the stock price didn't do much. It popped initially after hours that Wednesday, but it was down for the rest of the week. So this massive growth was, which obviously does come against those easy to compare periods, was driven by, once again, that first 5G capable iPhone. So overall iPhone revenue for the March quarter rose 65% to about $48 billion. And the share of new iPhones being bought out of all their sales is growing up. So the iPhone 12 is now accounting for more of these sales. The remote environment has also continued to drive iPad and Mac sales, which is great news for the company, because over the last several years, those have not been big growth areas. But in 2020 and so far in 2021, those have done really well. So last quarter, Mac sales rose 70%, with iPad sales up about 80% to about $8 billion. So yeah, as we mentioned, we should note that they also grew 88% in China. So big growth, return to growth there. Wearables were up 25% and services were up 27%. So the business is continuing to grow. Once again, though, the iPhone is still the core business, especially when they're in a cycle where they've released a new phone. So the iPhone 12 will continue to be very, very important. As we mentioned, the stock popped after hours following the release, but it fell later in the week. So along with the possibility of deceleration, there are some other worries going on with Apple that people should know before they consider investing in the world's largest company. So last week, Apple rolled out some software changes to its iPhone and iPads to make it harder for apps to track users across the internet. CEO Tim Cook and the company in general are actively promoting these efforts as governments and more consumers become a little bit more worried about privacy. Facebook and other companies have questioned Apple's motives and its tactics in this matter. Given this backdrop, the company also is now facing two other challenges. So Apple was charged last week, at the end of the week, by the European Union with antitrust violations for allegedly abusing its control over the distribution of music streaming apps. So Apple still has a chance to argue before the EU's regulatory commission before it renders an actual decision. So I'm just going to read from a Wall Street Journal piece recently that kind of sums up what's going on with the EU and what they're charging or trying to charge Apple with. So the European Commission, the EU's top antitrust enforcer, on Friday issued a charge sheet against Apple that says the iPhone maker squeezed rival music streaming apps by requiring them to use Apple's in-app payments system to sell digital content. The case stems from a complaint by Spotify Technology, which competes with Apple Music streaming service. In addition, EU regulators say Apple, quote, distorted competition by limiting how app developers can inform users about cheaper ways to subscribe outside the app. Apple's in-app payment system imposes a 30% commission on purchases inside many of its most popular apps. And then the last thing I'm going to read from this Wall Street Journal piece was saying, quote, this case is about the central role of apps stores in the digital economy. So this could end up being pretty important going forward, and certainly worth watching this very closely for Wall Street and in general if you're thinking about investing in Apple. Meanwhile, the trial between Apple and Epic Games, which makes Fortnite the widely popular video game, starts on Monday. Epic is arguing that Apple engages anti-competitive behavior in its app store. So similar thing going on in the EU, in the company's tight control of its apps, what can be installed on its devices, and requirements that transactions on those apps run through its own system. So you're going to hear more and more about this going forward, especially since the case is just starting. With that in mind, Apple is obviously going to be fighting back against all of this. They have billions and billions of dollars in cash that we're going to get to later. Epic is clearly a much smaller company than Apple, so it's worth going over both of those situations. As I said, that should be monitored very closely. So with that in mind, Wall Street is really focused on Tim Cook's mission to continue to make much more money from its massive and growing user base. As we mentioned, App Store is a big part of that. It also Apple streaming, which is what Spotify is complaining about, its competitor. It has Apple Music, as well as subscription news offerings, video game platform, digital workout classes, much more. So it said during the March quarter that it added 40 million new paid subscriptions from against the previous quarter. So they've reached over 660 million paid subscriptions across its various services. This is up 145 million from the year ago period. And they also said in the earnings call, it was twice the number of paid subscriptions we had only 2.5 years ago. So really impressive growth. And it's a big reason why some of these upcoming, the case against Epic Games and some of the EU stuff is certainly worth monitoring long term. But who knows what the implications will be and what will happen with that. But it's definitely worth knowing that they have continued to grow these subscriptions. So they have 660 million paid subscriptions across all these various services we just mentioned. So with this in mind, there's a reason this company is worth $2.24 trillion, making it the largest, most valuable company in the world, outpacing number 2, Microsoft, which is sitting at around $1.9 trillion most recently. So Apple stock had been run up after the coronavirus lows. It was driven by its stability, its tons of cash, that 4-for-1 stock split, the growth outlook. The company closed last quarter with $83 billion in net cash. They plan to keep buying back stock, paying dividends. They're trying to reach what they call a cash neutral position over time, which is great news for investors. It's going to be very hard to get to that cash neutral position over time because they continue to pull in billions and billions of dollars in cash. So we should note that the company announced last week, a 7% increase to its cash dividend to 22 cents per share, and that the board authorized an increase of $90 billion to its existing share repurchase program. So for some investors, owning Apple, even if maybe its massive growth days are going to be a little bit behind it, especially considering what it's done in the last 5 years, that dividend, the buybacks, and just its stability alone are worth holding it for much longer to come. So now we're going to go ahead and take a look at what our estimates are calling for going forward. So after this massive quarter, our estimates are calling for Apple to do another 19% growth on the top line and 46% growth on the bottom line. So for the full year, we're calling for about 28% growth to $351 billion in 2021 and 50% growth on the bottom line. So massive top and bottom line growth. And we're calling for another 6% growth on the top line after that, in slightly less, 3% growth in 2022. But against these hard to compare periods, any growth for 2022 is rather impressive. And then since the report, it's seen a lot of positive analyst revisions. So the company went from its Q3 consensus estimate of 83 cents per share all the way up to 95 cents per share. And now we're calling for $1.12 per share for Q4 instead of $1.01 per share. So some positive outlooks on the bottom line. This helps the stock grab a Zacks ranked number one strong buy at the moment. It also has a B grade for growth, in an A for momentum in our style score system, and its industry sits in the top 33% of our 250 plus Zacks industries. And then in terms of brokerage recommendations, which some people don't love those, but they play a role in stocks no matter what. People like, so out of the 26 brokerage recommendations that Zacks has for Apple, 20 come in at strong buys at the moment, with 3 more at buys and the other 3 at a hold. So out of the 26, 23 are either buy or strong buy, the rest at a hold, and none lower than a hold. So that strength is still there. People are still very bullish on Apple long term, even if you do see this near term deceleration against these hard to compare periods. So if you're a longer term investor with a horizon of, say, a year plus, Apple was likely still going to be a positive investment, even if that growth is behind it. So with this in mind, it's good to take a look at the stock price and what it's done relatively recently. So since last May, the stock is up about 83%. So 83% over the last year. This outpaces the tech space, the Zacks tech space of about 66%, and outpaces Amazon and Microsoft as well. It's almost doubling both of those stocks over the last year. With that in mind, it's recently slowed down a bit. So over the last 6 months, Apple's only up about 16%, which actually lags the S&P 500's 23% climb, as more people are hopping back into those cyclical plays from finance and energy and construction. So we should note that then, if we look over the last 5 years, this is where you can see the strength we're talking about. Apple's up 500% over the last 5 years. This tops Microsoft's 450% and Amazon's 400%, and the tech sector's 200%. So that 500% jump over the last 5 years could be also playing a role in why maybe there's just less positivity after a blowout quarter, just because the stock is already up so big. With that in mind, the stock's trading at a discount compared to the broader tech space. It's trading at 26.2 times forward 12-month earnings, which actually comes in right near its year-long median as well, which is a positive sign for investors as well. With that in mind, Apple popped roughly 1% through Monday morning trading. It's sitting at around $132.75 per share, so $133 a share, which is about 7% off its January records. Its RSI, which is that relative strength index, is sitting at about 55%, so just right above neutral levels of 50 and well below those oversold levels of 70. So longer term investors might want to consider Apple stock for all the reasons we mentioned. It has the growth, it has the diversity. They're expanding beyond the iPhone. iPad and Mac sales are doing well. That services business is going to continue to boom, even though there are some worries with the EU and this suit from Epic Games. Apple also has that massive team to fight back against all this as well. So if you're a longer term investor, there's certainly reason to be a little nervous about Apple maybe in the near term, but it has a Zacks ranked number one strong buy at the moment, and it's certainly worth taking a deeper dive. And obviously, it's no shocking thing to say buying the most valuable company in the world that's going to continue to buy back stock and pay dividends might not be a bad longer-term investment as a part of a broader portfolio. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.